Good morning, everyone, and thank you for joining us. My name is Jason Cogdell. I'm the General Counsel and Benefits Attorney for ProBenefits, and welcome to our first webinar of 2018. Feel free to consider this an early Valentine's Day present, and for all those of you who may not be on the ball, that's a reminder that your one-day warning is in effect. This is a short webinar. As such, I'm not going to take live questions, but just plow through the material, and we won't be together long. As usual, and as a reminder, a copy of the slides and a YouTube link to the recording will be provided with all registrants that you're welcome to use. You're welcome to share any questions that you have. You can submit to compliance@probenefits.com, and we'll do our best to get back to you on a timely basis. This session, our first webinar of the year, is a webinar short on the topic of supplemental or ancillary benefits, also referred to by some as worksite benefits. This is an area that we get a lot of questions, and because we get a lot of questions, both related to our Section 125 administration, what can be pre-taxed and what cannot be pre-taxed, and related to our ERISA compliance services, what is subject to ERISA or what is subject to COBRA. I thought that this might be a good back to the basics topic to start the year off with in terms of the short webinar. So I hope that you find this helpful. For purposes of this discussion, we're going to consider the main, most common employer provided benefits to be retirement and medical insurance. Not every employer has those two benefits, but most all employers of any size have a retirement plan and have a medical insurance plan. Of course, only those employers that are subject to the employer mandate of the ACA are required to have medical insurance. Most employers provide it voluntarily, even in the small group market. But let's consider those to be the main primary benefit. Certainly they're the main ones from a financial perspective and a budget matter for the employer. In that every other benefit provided by the employer is a fringe benefit or a supplemental benefit or an ancillary benefit. Now, for those that are health and welfare plans that are subject to our discussion today, I'm going to refer to them as supplemental benefits. Of course, employers provide other benefits beyond health and welfare, snacks in the break room, employee anniversary recognition gifts, and performance rewards and those types of things. I'm not going to cover those, just strictly deal with those that we consider part of the employee benefit platform. So those are the kind of benefits that we're going to be talking about today. And my goal is to simplify things, and I'll identify what are we talking about, what's the best terminology, the tax issue, and a couple of other best practices and reminders. First, a word about terminology. And as a disclaimer, this is my opinion from many years of working with employers and advisors regarding these topics. But my observation and my opinion is that the common term that is used to describe benefits that are not retirement and they're not health insurance, particularly benefits that the employee pays all or most of the premium, is that people like to refer to those as voluntary benefits. And that's a common thing that we hear in our industry. And the carriers use the word voluntary a lot. I think a best practice is not to use the word voluntary. I don't think voluntary is accurate for several reasons. First of all, every benefit that an employer provides is voluntary. The employee doesn't have to enroll in the retirement plan. The employee doesn't have to enroll in the medical plan. Even if the employer is paying for all of a particular benefit, health or otherwise, the employee doesn't have to enroll. In nearly every case, with a minor exception, the employee can opt out of any benefit provided by the employer, even if paid by the employer. So I don't think voluntary is the right designation. Secondly, the word voluntary actually has significance when it comes to ERISA, because ERISA, which is the federal law that governs all employer-sponsored benefit plans, ERISA includes an exemption for any plan that is truly voluntary. And what a voluntary plan looks like under the ERISA exemption is an individual benefit that is not sponsored by the employer. An example would be something provided by a carrier like Aflac or Colonial or Allstate. It's just an individual benefit that the carrier, the seller of that benefit, which may be of no value and may be of small premium, but that carrier or seller of that benefit can come on campus and sell it to the employees, but the employer really doesn't sponsor it. The employer doesn't allow it to be paid for with pre-tax salary deductions. And if the employer doesn't formally sponsor it or advocate it to the employees directly, then that benefit would be within the voluntary exception to ERISA. So since ERISA references voluntary plans, I think it's best practice for us not to refer to group sponsor benefits as voluntary, even if the employee is paying all of the premium. I think the better word for that would be a non-contributory benefit or an employee paid benefit. And certainly these come under the titles of supplemental, which I think is the best term, ancillary, which is fine, or a common word that is used these days is worksite. Now, typically worksite refers to, benefits other than necessarily life and disability, also some of the health-related supplemental or ancillary benefits such as cancer, critical illness, hospital indemnity, gap coverage. So I think the best word to describe all of these benefits is supplemental. These benefits are supplemental to the main benefits provided, retirement and health insurance, which of course are a big deal from a financial and budget perspective, as I said. And let's try to migrate away from the word voluntary. So that's just a matter of terminology and opinion. So now, what are we talking about? What specific benefits? And the next key issue, not only should we identify these benefits, but how should they be handled from a tax perspective? I'm going to start by giving you 3 slides, which include what I think are all of the common supplemental benefits that are non-taxable. And non-taxable means 2 things. Number 1, it means if the employee enrolls and the employee is paying part of the premium, that premium can be paid with pre-tax salary deductions. Of course, as a reminder, that benefit needs to be listed in the employer Section 125 plan, also known as flex plan or cafeteria plan. That benefit needs to be listed. If so, then the employee can pay his or her share of premiums with pre-tax dollars. If the employer pays all or part of the benefit, then that benefit is not taxable to the employee. So the employer is not paying FICA on it. The employee is not paying anything on it. And if the employee pre-taxes, the employee is saving federal, state, and FICA. So this is the best deal from a tax perspective. And hopefully we all understand the significant tax benefits of Section 125 plans. So these are listed. I'm not going to go into any significant detail on these other than just to identify them. Group dental and vision are obviously common supplemental benefits, whether paid all by the employee or paid all in part by the employer. Group term life up to $50,000 is tax-free. This also goes by the term basic life, and basic life is not a formal term. It just typically means a group term life policy with a coverage amount or face value up to $50,000. The premiums for that coverage are not taxable to the employee, whether paid by the employee or paid by the employer. But as you'll see on a later slide, any group term life coverage that's provided above $50,000, the excess above $50,000, the employee has to be taxed on the premium, whether paid by the employer or paid by the employee. Whatever that coverage is above $50,000, doesn't matter what it's called, voluntary life, supplemental life, which I think is the best term, or basic life, and let's say the basic life provided is $80,000, anything above $50,000, the employee has to pay taxes on the premium for the portion above $50,000. Accident coverage is a tax-free benefit. Technically speaking, the last 2 bullets there, short-term and long-term disability, technically speaking, those can be pre-taxed, although a best practice is for those to be taxable to the employee so that any future disability benefit is tax-free to the employee rather than taxable. And that's a kind of an unusual IRS rule, but a best practice is for those benefits to be post-tax. Other benefits that come in under this supplemental umbrella, flexible spending accounts, as our company administers health FSAs and dependent care FSAs. Also, health reimbursement arrangements, employer-funded accounts for out-of-pocket medical or dental or vision expenses, non-taxable to the employee. HSA bank account contributions, whether employer or employee, are tax-free. And the final screen of tax-free supplemental benefits are those that I mentioned. The three I mentioned at the top are what some people now refer to as worksite: critical illness insurance, cancer insurance, hospital indemnity coverage. Another example would be what is known as gap insurance. The reason that the asterisk are beside those three is because these benefits, if provided on a group contract, are ideal for tax-free treatment. If they're not on a group contract, if they're within that ERISA voluntary exemption that I mentioned earlier, they're individual products, the best practice is to handle those with post-tax deductions. That will keep them out of ERISA, and that will also mean that the Section 125 qualifying event rules don't apply if they're not on a group contract. But if there's a group contract, then ERISA applies, COBRA may apply, and so that certainly they can be pre-tax. There's no issue there. And I won't get into the details around those benefits now, but if that's something you're working with, employer if you're sponsoring those benefits, advisor if you're helping your clients with those type of worksite ancillary benefits, I'll be happy to provide more information. The final two bullets: telemedicine, which is a relatively common benefit. It can be pre-tax. By the way, it is subject to ERISA and COBRA. And then benefits that are qualifying as provided through a compliant wellness program or an EAP or an on-site clinic are generally non-taxable to the employee. So that's a very quick run through of the tax-free benefits. Now, what about the taxable benefits? Taxable means, as I mentioned with the group term life over 50K, if the employee pays for these benefits, they should be paid with post-tax salary reductions, and tax is taken out and then the deductions are taken so the employee doesn't save tax money. That's the best way to handle it. That's what the IRS requires. Or if the employer pays all or part of any of these benefits, what the employer pays should actually be added to the taxable income of the individual employee, either on a payroll basis or with a tax adjustment at the end of the year on the W-2. Other taxable benefits besides group term life over 50K would be spouse or dependent life insurance, any type of cashable credit that the employee receives either through a benefit credit program in the 125 plan or a wellness reward. Long-term care insurance cannot be pre-taxed, even though there's an exception with HSAs that HSAs can reimburse some forms of long-term care coverage, but premiums for long-term care cannot be paid on a pre-tax basis by employees. Any benefit provided to a non-tax dependent, that's a supplemental ancillary type benefit, such as a benefit provided to a domestic partner or other ineligible individual, cannot be provided on a tax-free basis. And then other benefits that you may utilize, sometimes I'll see a prepaid legal program or some type of discount program that an employer sets up for its employees to take advantage of. Those cannot be provided on a tax-free basis by the employer. That's a very quick run through of those slides, but I wanted you to have the list, and again, we'll provide a copy of the slides to you. As a quick reminder, one common mistake that employers make relative to supplemental benefits is that if the benefits, such as a group term life coverage option, if the benefit provided by the employer has an option for either portability or conversion, so that the employee, when he or she loses eligibility by termination of employment or otherwise, can basically port or convert that policy into an individual, personally owned policy by them, maybe even changing the type of coverage, such as from a group term life to a whole life conversion. If there's a portability or conversion option, the employer is legally required to let the employee know. Now, the carrier may do it for you, and if so, great. But if the carrier does not, the employer is responsible to do it. So a best practice for the employer is to make sure that you know whatever supplemental benefits you're sponsoring, whether they can be ported or converted, and if so, at the time of loss of eligibility, including a termination letter where you're spelling out benefit options to notify the individual that they have a limited time frame, is typically 31 days, in which they are going to provide enrollment and commit to the portability or conversion option. So I list that reminder simply because it's a common mistake. And then finally, in conclusion, this is a broad checklist that applies to any supplemental benefits. It really applies to all benefits, but is important because this is something that employers don't always do for supplemental benefits the same way we may, for example, for the group health plan. And that is, number one, anytime we've got a benefit, whether new, whether old, whether we've had it for a couple of years and we're taking a second look at it, have we done eligibility correctly? Most importantly, whatever the document says, whatever the insurance contract says, or whatever the plan summary says, or whatever our benefit summary that we provide to employees says, everyone who's eligible needs to have been offered the coverage. And that's just kind of a foundational requirement for employee benefit plans. Secondly, have we set it up correctly for taxes? Not only have we followed the rules, but are we following the best practices, as I mentioned for disability? Yes, we could pre-tax it, but that's not the best practice. Let's make sure we're doing it not only the correct way, but the best way, both for our employees and for the company. We're saving as much money in taxes as possible. Does the benefit require an SPD? Translated, is that benefit subject to IRS rules like a Section 125 plan or an FSA or an HRA? Or is it subject to ERISA, as all group-sponsored benefits are: life, disability, dental, vision, and group-sponsored worksite benefits? Does it require an SPD? If so, do we have one? Are we relying on the carrier booklet? Do we need to do something else? What about telemedicine? For example, we may not have gotten a booklet from the telemedicine provider. Do we need one? By the way, the answer is yes. And then finally, does COBRA apply? The answer to that will be no for some supplemental benefits, life, disability, but COBRA will apply to other of these supplemental benefits: health FSA, HRA, telemedicine, certain of the worksite benefits if they're group sponsored and if they provide actual medical treatment. So we need to do this analysis. So this is our checklist for all these benefits, and I think this will be an excellent way to do a quick refresher sometime in 2018 on the benefits you have and certainly the benefits that you consider adding going forward. In the interest of time, I'm going to wrap that up now. As I mentioned, no live questions today. This was intended to be a short webinar, a mini webinar, and so I'm going to conclude now. If you would like to submit any questions, you may do so by email at compliance@probenefits.com. As always, thanks for your attendance and have a great day.